Hello, and welcome back to Explain the Charts, your channel for detailed, no-nonsense technical analysis. Today is October 2nd, 2025, and we are diving deep into one of the most talked about stocks in the market, Amazon, ticker symbol Amazon. We have a lot to cover, from major news developments to a multi-timeframe analysis of the charts. First, let's get a handle on the current news and sentiment surrounding the company, because it's a real mixed bag of bullish optimism and bearish concern. On the bullish side, a major headline is the Wells Fargo analyst upgrade, setting a very optimistic price target of $280. This optimism is heavily tied to their conviction that Amazon's partnership with AI company Anthropic will drive significant revenue acceleration for Amazon Web Services, or AWS, through 2026. They believe the collaboration on an AI supercomputer, dubbed Project Rainier, is a game-changer that the market is underestimating. Another positive catalyst is the recent closing of the de minimis loophole on U.S. imports. This policy change hurts competitors like Temu and Shein, who relied on it, while creating a significant tailwind for Amazon's massive U.S.-based e-commerce and fulfillment operations. However, it's not all positive news. There are persistent concerns that AWS is losing market share to competitors like Microsoft and Google, a fear that was amplified after their Q2 report. We also can't forget the upcoming quarterly earnings report scheduled for October 28th, which will be a pivotal moment for the stock. Investors will be watching AWS growth numbers like a hawk to see if the AI investments are beginning to pay off or if the competition is truly closing in. So we have a classic battleground scenario, strong bull case based on future AI growth and e-commerce advantages, against a bear case centered on competition in its most profitable sector. Now let's switch over to the charts and see how this narrative is playing out in the price action. Here we have the daily chart for Amazon, and we can see the story of the past year has been one of significant volatility. The stock hit a 52-week high of $242.52 back in early February before entering a sharp correction phase. That correction found a bottom in early April, establishing a major long-term support zone around the $161 to $170 area. After recovering from those lows, the price climbed steadily into late July, reaching back above $230. But what I want to draw your attention to is this massive gap down that occurred right at the beginning of August. The stock closed around $234 on July 31st and opened the next trading day under $218, following its Q2 earnings report. The news mentioned an 8% stock tumble due to concerns over slowing cloud revenue, and this is the direct result of that sentiment on the chart. This event created a powerful resistance level at the pre-gap price of around $234. Following that drop, the price spaced out and began a steady climb, eventually breaking through that gap-fill resistance in early September. The price pushed as high as $238 before facing rejection and beginning the most recent pullback. This brings us to the current price structure, where we've seen the stock pull back from those September highs. The crucial thing to note is where it found support in the last few days of September, right in the $216 to $218 range. This level is now our most immediate and critical short-term support zone to watch. Yesterday's candle, on October 1st, was a very strong bullish candle, showing a rejection of those lower prices as it moved from a low of $216.61 to close at $220.63. This confirms that buyers are actively defending that $216 support level for now. So, on this daily time frame, we are in a consolidation phase after a significant pullback. The long-term trend since the April lows is still up, but the short-term trend since mid-September has been down. The battle is now to see if the longer-term uptrend can resume or if this recent weakness will continue. Our key resistance levels to watch are the September high around $238 and, of course, the all-time high at $242.52. On the downside, the immediate support is $216, followed by a psychological level at $200, and then the major support zone down near $170. Let's zoom in on the daily chart to get a clearer picture of the action since that big earnings gap in August. As you can see, the recovery from the post-earnings low around $211 was methodical, grinding its way higher through August and into September. That rally culminated on September 9th with a high of $238.85. Since then, the price has been in a clear downward channel, making a series of lower highs and lower lows. The sell-off accelerated around September 23rd, where we see a large red candle breaking below the $228 level. This led to the test of our critical support zone between $216 and $218. The price bounced nicely off this zone on September 30th and followed through with strength on October 1st. This bounce is the first sign that the short-term downtrend may be pausing or reversing. However, we are not out of the woods yet. The price is currently sitting right below a potential resistance area around $222, which was the low from September 23rd. A break above this level would be the first step for bulls. Volume during this recent bounce has been about average, which is something to keep an eye on. Ideally, bulls would want to see an increase in volume on any move higher to confirm conviction. Conversely, if the price gets rejected here and rolls over, a high-volume break below $216 would be a very bearish signal. This focused view really highlights the importance of this current price zone as a potential inflection point. Now, let's drill down to the 1-hour chart to get an even more granular look at this recent price action. Here we can see that downward channel from the September highs very clearly. The bounce from the $216 lows on September 30th and October 1st was quite impulsive, which is a positive sign for the bulls. Since hitting a peak yesterday at $222.15, the price has been consolidating sideways in a tight range. This type of consolidation after a strong move is known as flagging and can often lead to a continuation of the prior move. For traders, the immediate range to watch is between yesterday's high around $222 and the support formed during this consolidation around $219.50. A break above $222.15 on the hourly chart would signal a potential continuation of the bounce, with the next target likely being the $227 to $228 area, which was a previous support level. On the other hand, a break below $219.50 could suggest the bounce has failed, and we might see a retest of the $216 lows. This hourly view is excellent for identifying key short-term entry and exit points. Finally, for the intraday traders, let's look at the 15-minute chart, focusing on the last couple of days. We can see the strong, sustained buying pressure throughout the day on October 1st, taking the price from the $216s to over $220. The high of that day was set in the late afternoon at $222.15. Since then, price action has been choppy and range-bound. You can see the price is essentially trapped between that $222.15 high and support around the $219.50 to $220 level. This is a classic wait-and-see pattern. The market is digesting the recent move and waiting for the next catalyst or influx of volume to determine direction. A day trader might look for a high-volume break of this range. A break to the upside could be traded long towards the next resistance, while a break to the downside could be a short opportunity back towards the weekly lows. For now, patience is key on this time frame until a clear direction is established. Okay, let's go back to the daily chart to recap and put everything together. Based on the news and the technicals, AMZN is at a critical juncture. Let's summarize the most important price levels you need to have on your radar. Immediate short-term support is the $216 to $218 zone. If that breaks, the next major long-term support area is way down in the $160 to $170 range. For resistance, the first hurdle is the recent high around $222. Above that, we have resistance in the $230 to $238 zone from the September highs. The ultimate prize for the bulls is a retest and break of the all-time high at $242.52. So, what's the outlook? Let's look at the bullish case first. If the positive narrative around AI and AWS growth gains traction and the market sentiment remains positive, Amazon holding the $216 support is key. A strong earnings report on October 28th could easily propel the stock through the $238 resistance and back towards all-time highs. I would assign a moderate likelihood to this, perhaps a 60% chance, provided earnings meet or beat expectations. Now for the bearish case. If earnings disappoint, particularly with AWS revenue or forward guidance, it would validate the market's fears about competition. In that scenario, a break of the $216 support could happen quickly. This would open the door to a much deeper correction, potentially towards the psychological $200 level or lower. Given the current market uncertainty, I'd place the likelihood of this scenario at around 40%. The primary thing to watch is the earnings report on October 28th. Until then, watch the price action around the $216 support and $222 resistance levels to gauge short-term sentiment. A decisive break of that range will likely signal the next short-term move. Thank you for tuning in to explain the charts. Remember, all content on this channel is for informational and educational purposes only and should not be considered financial advice. Trading and investing carry significant risk, and you should always conduct your own thorough research and consult with a financial professional before making any decisions. Trade smart, and we'll see you in the next video.